All right, so let's begin. On the Money Show, we make sure that we just don't talk about investing in mutual fund, but also help you meet the brains behind the funds. And today we are going to talk about NPS. In the week's PTO Fund Manager, we have on board Sriram Iyer, CEO, HDFC Pension Management Company, to discuss about how can you start investing early in NPS to achieve your retirement goals. Sriram, good evening and welcome to the show. A very well-known retirement product investment instrument, NPS, and I can say, looking at the amount of questions that we get from our viewers, it's equally confusing for them in terms of product features. So let's break this down for our viewers, Sriram, and let's begin with how efficient it is, or NPS is, as a retirement investment product.
Good evening, Kavita. I think you hit the nail on the head. I think it's a product which is very poorly understood, in my opinion, and I'd like to start by pointing out four key benefits, and there are of course a number of other benefits, but I'm going to talk about the top four benefits that this product offers. As you would all know, as you would know, and your viewers would know, this is a product that was started by the Government of India for government employees in the year 2004. Eventually got opened out for private citizens the year 2008-2009, and ever since this business has grown from strength to strength, though the awareness levels continue to be fairly low. There are four key benefits. As I was saying, the biggest benefit that I see in this is obviously the fact that there is a very strong tax advantage or tax incentive that the government offers for investing in NPS, because India is a country where the social security system doesn't exist, and therefore helping citizens create a reasonable investment corpus or a retirement corpus is the key focus that the government has, and therefore there are some very attractive tax advantages that are available for investing in NPS. The most common one that's understood by most investors is the 50,000 rupee benefit over and above the ATC 1.5 lakh benefit. Incidentally, you can actually use the 1.5 lakh ATC benefit also to invest in NPS. So therefore, for a retail investor, up to 2 lakh rupees of tax benefit or tax deduction can be claimed if you invested in NPS. So that's point number one. For a corporate employee, however, for a salaried employee, actually up to 10% of the basic of the individual can be contributed towards NPS, which is a very, very powerful feature. So that's in fact, I would say a very, very powerful, feature that this product offers, and it is unparalleled truly. Second is it is an extremely low cost, actively managed fund. In fact, I would argue that this is possibly the lowest cost actively managed fund, lower than actually index funds as well in terms of cost. The fully loaded cost, and this was a study that the regulator had instituted, last year, and the conclusion that was drawn was that of course the fund management fees, as you would know, is between 3 paise or 3 bips and 9 bips, depending upon the size of the fund that the fund manager manages. But the fully loaded cost, as far as the subscriber is concerned, including other costs as well, is less than 10 bips per annum. What does it mean? It essentially means that for every 100 rupees that is getting invested, effectively 99.9 rupees is getting invested in the underlying. Contrasted with, let's say, other actively managed funds. And I'm not for a moment suggesting that those actively managed funds should not find a part in your portfolio. It should, but I'm just trying to draw a comparison in terms of cost. So other actively managed funds typically charge between 1 and 2%. So therefore, for every 100 rupees that gets invested, only 99 or 98 rupees eventually gets invested in the underlying, and that in turn gets compounded over long periods of time. And therefore, the impact in terms of the final corpus, purely on account of the fact that this is a low cost product, can be as high as 25-30%. Of course, it's a function of what is the rate at which the fund is growing and so on and so forth. But, there are, some basic examples that will suggest that the difference in corpus on account of lower cost is as high as 20 to 30%. Thirdly, it's an extremely flexible product. There are, of course, we will talk about the fund choices available slightly later, but not just does it offer you flexibility in terms of fund choices, but it also allows you to invest in whatever quantum you want at whatever frequency you want. And as I said, at whatever frequency or whenever you want to invest, right? Finally, and this is again a very important, benefit about this product, is that this is a market-linked product, which means that whatever you're investing in this product is visible to you day in and day out in the form of an NAV that gets published. In fact, all the pension fund managers are also expected to publish the holding of their respective pension funds right in the last rupee. So you will see the disclosure available on the pension fund manager websites. So these are some of the key advantages that the product offers. Finally, and this is one thing that is not talked about enough, which is that this product actually forces you to stay invested for long periods of time, right? So this whole issue of investor return versus investment return being different in most other products which have a entry exit, and because of noise in the market, people tend to get out and get in. In this product, you are forced to stay invested because you cannot take out the money. Of course, you can take out some parts of the in your invested corpus at different points of time for specific reasons, but a large portion of the corpus has to remain invested till you superannuate, which is till the age of 60, or you could hold on till the age of 75 as well as per the latest guidelines. And that in itself will make sure that the corpus that you have created or the amount that you've invested builds up to a fairly meaningfully large corpus. So it's a very efficient product, actively managed, market linked, with tremendous flexibility and of course low cost that I spoke to you about. So those are the 4 or 5 key benefits that I wanted to shine the light on before we move to the next question, Kavita.
Although there is a lock-in in this product, I think till the age of 60, there are premature withdrawals or partial withdrawals which are allowed based on certain conditions. So what are those conditions, Sriram, if you could just highlight on that?
Minimum that you need to hold this product for, or rather you need to hold your investment for, is 5 years. Beyond the period of 5 years, you can do a full withdrawal. That full withdrawal will require you to annuitize. 20% of the corpus that gets accumulated is available to you tax-free. The remaining 80% needs to be annuitized, by which I mean you need to buy an annuity pension product with the 80% of the corpus that has got accumulated. Contrast to this, if you continue to hold on to this till the age of 60, then 60% of the corpus that gets accumulated is available to you tax-free. The remaining 40% has to be used for purchase of an annuity product. So that's the difference. And of course, through the life of the product, thrice you can withdraw up to 25% of your own contribution into the product, right? So those are the exit options that are available to you. However, given the fact that this is a product that is meant to help you create a meaningful retirement corpus, our advice to subscribers is to keep this invested and use your other liquid options available to you in other funds, in other vehicles that are there, so that you don't break this journey of the power of compounding that you're otherwise going to get in this product, and the low cost, of course, that this product offers you.
So let's, Sriram, also talk about the cost structure. You've mentioned this twice, that it's a low-cost product. In what way is it low cost? And from an investor's point of view, how is the costing structure as compared to the other investment instruments?
So the biggest element of cost in this is what is referred to as the fund management cost, or in any actively managed fund management charges are the highest, form the largest portion. In the case of NPS, the fund management charges are a function of the size of the fund. So I'll give you so it's a sliding scale. So up to 10,000 crores of assets under management held by a pension fund management company, the pension fund manager is allowed to charge up to 9 bips, 0.09%. From 10,000 to 50,000, you're allowed to charge 0.06%, and from 50,000 till 1,50,000 crores, you're allowed to charge 0.05%, and greater than 1,50,000 crores of assets under management at a pension fund manager level, you can only charge 3 basis points. So this is the fund management charges. Other than this, at the time of opening the account, there are some very, very moderate charges that are levied. So for instance, at the time of opening the account, you pay a 400 rupee account opening fee, and then there are some charges that you pay at the time of contribution. But as I was telling you, if you take all of these costs into account, if you look at the weighted average cost of managing money under NPS, it is less than 10 basis points, contrasted with, let's say, 1% to 100 to 200 basis points. So that's a contrast. So it's almost 1/10 to 1/20th of the cost of managing money in other actively managed products. So that's the comparison between the two. Kavita.
Sriram, let's also talk about the schemes, which investors can invest in. And before that, I think active choice and passive, active and auto choice, which you might want to highlight on. And then in a year's time, how many times can you change the schemes or, have a different kind of a strategy for yourself?
So I want to first start by explaining quickly what is an active choice fund and an auto choice fund. Under the active choice option, as the name suggests, the investor has the option to actively manage their asset allocation across the three asset classes that are available under this scheme, which is equity, which is signified as E, corporate bonds, which is signified by C, and government securities, which is referred to as G. So under E, C, and G, as an active choice investor, you can have whatever combination that you choose, irrespective of the age at which you are. The only condition that this active choice option requires you to do is that you cannot have an exposure of more than 75% to equity. So there is a mandatory 25% that you need to have between C and G, which is corporate bond and government securities, which means that an investor who starts early, let's say an investor starts contributing through his, let's say, corporate NPS, as I was referring to earlier, starts contributing towards 10% of his or her basic into NPS, you can actually choose to have 75% exposure to equity right through your lifetime employment lifetime, but actually beyond that as well. So that's the active choice option. Of course, you have the choice of calibrating it to less than 75 as well. You could have a 50% exposure. So active choice essentially is the investor is given the choice of deciding what the combination of asset classes can be. That's the active choice option. The auto choice option, which I like to refer to as the fill it, shut it, forget it option, is actually ideally suited for a large number of investors in India who do not want to get involved in the asset allocation decision, right? So what this does is that it's a beautifully structured, option where up to the age of 35, you could have allocation in equity. So there are three types of auto choice options. There is the moderate, conservative, where 25% equity allocation happens to equity and 75% to corporate bonds and government securities. Moderate, where 50% gets allocated to equity and 50% to corporate bonds and government securities. And aggressive, where 75% gets allocated to equities and the remaining 25% gets allocated to corporate bonds and government securities. Now, the beauty is that this is the allocation at the time of getting in. From the age of 35 till the age of 55, which means for those 20-year period, what this product does for you, what the auto choice option does for you. Let's take the example of aggressive auto choice option, where the 75% allocation is to equity. So from your birth date, every birth date after 35 years, the allocation to equity will get pared down. So it is a reducing allocation to equity as you progress from the age of 35 to 55, which means that the risk of the investor is being automatically managed by the product without any intervention from the investor, which means that it automatically rebalances your portfolio in such a manner that at the age of 55, under the aggressive option, 15% allocation is what is left in equity at the age of 55, which means that as you get closer to your retirement age, your allocation to a riskier product, which is in this case equity, is pared down significantly. And therefore, in the initial stages of your investing life cycle, you have maximized the opportunity to make returns out of equity. And as you get closer to superannuation, the quantum of allocation to equity reduces. So that is how this product of the auto choice option allows an investor to actually bring down a risk with increasing age, and as one gets closer to retirement, your corpus is less volatile than what it would be at the age of 35. So that's the difference between the active choice and the auto choice option. Kavita.
Sriram, if I have to focus slightly on the annuity part, 60% is EEE, and out of the 40% of total corpus, you need to buy an annuity. What are the features of this annuity in terms of how do you get it? You get it monthly, you get it quarterly. Also, will that annuity be taxed, because that's the ultimate amount that's coming in your hand, in terms of pension. So what are the rules over there?
I want to first, clarify one thing. This is an EEE product, which is exempt product at every stage, which means that the final corpus that one is getting is also the corpus is fully exempt from tax. 40% out of that corpus is to be invested in annuity as a product, right? Which is a pension product, as it is, colloquially referred to. Annuity as a product, which means that you start getting pension out of the 40% that you invest in that. So that 40%,
entire 100%, right? But
So the
Sriram,
entire 100%.
I cannot withdraw the entire 100%. It is a mandatory
Cannot.
40% annuity that we have to buy. Even if we don't want to. What if someone doesn't want to? I mean, there is no option in NPS. I mean, you have to put in that money in your annuity. Just 60% is something that you get in your hand eventually.
Sure.
Yeah.
The reason why, and Kavita, I want to sort of spend a minute on this debate, that this is a debate that keeps happening as to you don't allow me to take the entire 100%. You force me to buy an annuity for 40%. The reality is that a very large number of investors do not really very well understand how to manage, let's say, something like an interest rate risk over the rest of their lifetime, right? So let's say you superannuate at the age of, or retire at the age of 60, and you, let's say, take the money out at the age of 60. The product forces you to lock in a certain amount of money at a fixed rate of return for the rest of your lifetime. That's what an annuity does, right? So what is an annuity? Annuity is possibly the only product which guarantees a fixed rate of return. And optically, the rate of return may potentially, you may say, what is so great about 6.5%? But the reality is that the 6.5% or 7% or whatever is the rate on and there are different options under annuity, with return of purchase price, without return of purchase price. I don't want to get into the complications around the annuity product. But if you look at the fact is that 10 years from now, the interest rate scenario may be very different, by which I mean it could be significantly lower than what it is. At that point of time as well, you will continue to earn the rate at which you've locked into the product at this point of time. So the annuity option actually helps you obviate or overcome the reinvestment risk that typically runs with respect to any fixed income option, right? Any fixed income option over a period of time, you do get into an issue of reinvestment risk, because when the product matures, then whatever product you invested in, let's say 5 years, 10 years from now, when it matures, the interest rate scenario at that point of time could be very, very different from what it is at this point of time. And therefore, this in some sense helps you manage the reinvestment risk for a portion of your corpus. So that's what this annuity option does for you, Kavita.
Right. I think that will be all for today, Sriram. Thank you so much for being on the show and covering the most crucial aspect of NPS. Thank you so much.
Entirely my pleasure. Thank you so much. Thank you for having me.
All right, time for a quick break, but then post that, let's talk about reviewing the performance of your mutual fund and how should you go about it in case of a regular or a direct plan after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Investing in funds is one thing, but reviewing your investment and the performance of the funds you have invested in is crucial for getting the most out of your investment. So, on The Money Show today, we will discuss how you can analyze the performance of your fund. We have Sandeep Pandey, Director, Basaf Capital Advisory Private Limited. Sandeep, good evening and welcome to the show. Very crucial assessment that one needs to do, and in fact make it a habit to do it for their investment portfolio. What happens is a lot of times people think that investing in a mutual fund is just like buying stocks. You have an entry time, you have an exit time, but when it comes to a mutual fund, you can decide an entry time maybe if you want to, but that's also not recommended even then. When it comes to seeing the performance of a fund, a lot of factors go into it, Sandeep. So let's break this down. When you talk about performance, this should be based on what criteria? Your fund's comparison with the peers, with the benchmark, or any changes happening in the fund management team. How do you look at your fund's performance? What are the criteria laid down here?
Kavita, first of all, thank you so much for inviting me for such a prestigious, a show as such. A lot of retail investors are fan of yours and always looking forward for your advice. And thank you so much once again. So coming back to, in terms of how to analyze your fund performance, more important aspect before it goes is the client profiling. Client profiling plays a very, very important role before you select a fund in terms of what is his goal, what is his objective in investing a fund, whether it's a short term, whether it's a long term. More importantly, what is his family composition, whether he's a first time investor or he's just because ads are coming, mutual fund sahi hai, he wants to just invest and take the ride. What is the risk behind it? So an advisor or the wealth management team, whether it's IFL, whether it's MK or the best of boutique firms which are there in India should analyze the risk profiler and then go to the fund selection. And more importantly, there are different kinds of parameters which you already covered very smartly in terms of what are the parameters one should look forward in evaluating the fund. So first, importantly, what we look forward is what is the risk-adjusted returns. So risk-adjusted returns shows what is the kind of risk a fund manager takes in generating that kind of return, whether it's 15%, 20%, or 25%. Okay, what is the risk behind that portfolio? For a debt scheme, the risks are different. For an equity scheme, the risks are different. And what is the consistency? So what we always tell our retail investors that these two parameters play a very vital role, and return should be the benchmark. You're not investing in the equity market just to invest. The returns play a very, very important role, and that's the end figure. Just like cricket, I'm a sports guy, so I always look forward for giving examples to my clients on basis of sports. So in cricket, if you hit a century, that's the end story, which gets reflected on the scorecard. You take a wicket, that's the end story. So same way in a mutual fund, what is the kind of return a fund is generating, whether it's 6 months, whether it's 1 year, whether it's 2 years, or since benchmark, that plays an important role. So this is one of the key parameters, is the return is the ultimate criteria for anyone to have as a judgment of that particular fund.
Sandeep, now just for example, let's take a scenario where the market is going down, okay? At that time, if someone wants to maybe exit a fund, okay, how should you be looking at the performance? How should you take that exit call when the market is already down?
So Kavita, again, very important point is that people get panicked. You have seen during the wave, the kind of corona wave, people panicked and lost crores of rupees in their portfolio, their hard-earned money itself. So here the advisor comes into play a very important part. The more the conviction, and I always tell my clients not to just invest in fund, but also give them the knowledge. I have a huge client base who are doctors and very well CEOs and top notch managing directors of company whose portfolio I manage. So I always try to give them the knowledge, what is the main objective of your, and whether this particular objective has been met by investing in this fund, and what is your tenure. Hence the profiling, which I earlier mentioned to you, plays a very, very important part. If the profiling and fund selection and the goal setting plays an important role, then naturally the ups and downs will not affect. And you have to remind the customer or the investor again and again that you have not invested for 3 months, 6 months, or 1 year. Your intention is to create a corpus either for your retirement or depending on purchasing a house. So why are you getting affected with a short-term kind of scenario where there is a war scenario, or there is a change in regulators or taxation? These are the bips which advisor plays important role in convincing about the goal objective setting, and about also giving that kind of strength that yes, the long term the markets are good, and India has always been a investment and hold strategy. Indian regulators also do not permit in doing short selling, and I don't think so. Our markets are well equipped unless it's in a very HNI or a very, very senior shark who's there in the market who can do short selling in the market. So most of the people who are there, retail investors, they buy and they hold. So when the markets are going down, I think so the advisor plays important part, and you need to be convinced about the objective and the economy about a country itself.
All right. And the same rule applies, Sandeep, when the market is on a high, and when you are seeing the profit ballooning from a fund, and if you want to take an exit call, will the same criteria work over here?
Yes, Kavita, it works. In fact, there is no harm in booking the profits unless and until you're going to park that money again into your fixed deposit or in your savings account, and your short-term goals are getting fulfilled. I think so, yes, booking profits from time to time also plays an important part. But there's a big difference in terms of booking profit and doing churning. So a lot of investors fall in a trap of advisor where 3 months back, a mid cap story was running, then a large cap story was running, and the advisor comes back to a customer again and again that move from A fund to B fund. So churning is where a dent happens to the retail investor, specifically the entry and the exit load. So the client needs to be aware, okay, what is the objective? Unless there is a fundamental change in that particular fund, whether there is some kind of integrity issue, if there is some kind of, a structural issue of that fund house, or there is some negative news like what happened in Axis AMC in terms of front running, people should avoid doing trades again and again, and you should give sufficient time to your fund manager to give you a returns. So your selection criteria of the fund is where you spend the maximum time, which is 70-80%, and then taking calls on a regular basis by sitting with your advisor plays an important part. So usually you should sit around 3 months, every quarter you should sit with your advisor and just reviewing the portfolio instead of taking decision again and again.
All right, one last question to you and then we'll wrap up this discussion. There is a lot that goes on having the right kind of expectation, having the real expectations from your returns. So how would you like to explain how investors can have a real return expectation, and how should they be altering it or modifying it as per the market movements as well? How can one be very realistic with their returns? Yeah.
So, Kavita, very important questions that many times, people get very anxious when you're getting a low return and get very excited when they're getting a good return. So, you have to always have a benchmark against your investment. If you're investing in a debt fund, your benchmark usually is a 10-year yield, GSEC bonds, which is ranging around 7 to 7.5% itself. So that is your benchmark. And in equity, if you're taking that kind of risk as such, so you should, if the Sensex is performing say 12 to 15%, your mutual fund should perform 3 to 5% more. So that is where you have to do an outperformance. And if you're taking an exposure of a PMS, the return, because you're paying a higher fees and more concentrated portfolio on a PMS, so naturally a return should be much, much higher than the benchmark, maybe outperformance or alpha generation of more 5 to 6% more than your benchmark itself. So you need to have your expectations right. And it should also, you should not get carried away that 1 year, if a fund is giving you a 50 or 60% return, or a PMS is giving you a high return, you need to also see what is the kind of risk an individual has taken, whether this kind of consistency for a long term is going to sustain in the market or not. And that's where your previous question of booking of profits plays a very important part. So this is what I would love to tell my retail investors who are watching the show, is that review your portfolios on a regular basis and keep something which is stable. Even Warren Buffett says that generating a 12 to 15% return from a long-term point of view is excellent, and is one of the richest investor in the world itself.
All right, Sandeep, with that, thank you so much for being a part of this show and explaining all the nitty-gritties involved with fund performance to our viewers today. Thank you.
Thank you, Kavita. Thank you so much. Take care.
All right, we move on. Let's take a quick break, but then post that we'll be joined by Feroz Aziz and a lot more on financial planning and ITR filing, and also your portfolio-related queries, which will be a part of this show after this break. Welcome back. You're watching The Buddy Show with me, Kavita Thapliyal, and now it's time for tax saving discussion. So with the deadline to file income tax returns fast approaching, perhaps it is the right time to review your investments and understand how you can invest in tax efficient manner. What are the do's and don'ts that one must keep in mind to save taxes? Let's welcome on board Feroz Aziz, Deputy CEO, Anandati Private Wealth Management, to answer all of these questions. Feroz, a very crucial period going on as far as ITR filings are concerned, and obviously a tax special class that we have started for our viewers also. Every day we teach them something or the other for their last minute ITR filing, but then today, efficient ways of having tax saving investments in your portfolio. And as far as the do's and don'ts are concerned, I'm sure you have a very long list. But then, why is it important to understand the most efficient way of tax investing and not just going into any product and putting in money because you just see a tax saving angle to it? Why is it important?
Kavita, good evening. Like you said, that tax can't be the primary objective of any investment. That has to be the second or the tertiary objective of investment. The first objective is return risk adjusted. If that makes sense from your portfolio standpoint, if its time of investment marries with your goal, all those are far, far more critical than taxation at all. Because tax on a specific instrument can never be computed. Because tax has to be at a file level, at a SSE level. So I might buy myself a 20% tax instrument, but if I have losses from equity, I can set it off. So point one I'm making is the primary objective of investment is to help you meet a specific goal. Second, how do you meet a specific goal? By buying instruments which are the best in terms of risk to reward or reward to risk they take. That's the second. So tax can just be an extra catalyst to enhance the probability of that product meritoriously forming a part of your portfolio. So that's why you should never go you should never change the chronological order of importance of criteria, choice of criteria.
All right, so let's begin with the do's list. Your choice, you pick, Feroz. The do's list or the don't list, whatever you say. Let's start with the do's list, tax efficient investing. Yeah, what do you have to say?
Yeah, of course, the do's are the more positive way of starting. So let's go with the do's first, Kavita. So first is make sure that when you're filing your return, the ATC claims are made, right? Because quite a few of them are voluntary, quite a few of them are involuntary. You might have started an SIP and a scheme long back, but that actually gives you a tax credit today as well. So make sure that your ATC is correctly computed. When you compute the advantages, if you've already overshot that budget, that will be an input to your strategy for the next year of investing. See, if the limit is 1.5 lakhs, and if I've already invested 2 lakhs this year, when I'm trying to compute, of course, there's no tax credit this year because you've already superseded the maximum limit, which is permitted. And that's remained static from 2014. So the next year, I'm very, very conscious that I don't need to make any other ATC investments. So that's point one. The second is employee provident fund is a great debt instrument. And quite a few of them use insurance policies, which are the diametrically opposite end in terms of return and risk reward. They choose that, but they take a traditional plan, but they skip their EPF installments, or they voluntarily choose not to be in EPF to the extent they can be, depending on their basic salary. So 8.1% is a large return. So use EPF rather than traditional plans is the second do. Third, which is missed out, every budget I see people wanting new gifts from the government. But when I look back and see, so many gifts are not utilized, but they like to have new gifts. LTCG of 1 lakh rupees, which is exempt on equity, please use that. Book your profits to the extent per financial year, per family member, book that 1 lakh and save that 10,000-11,000 rupees, including cess. This could be 3 do's, and I'll stop here to keep the monologue short, Kavita.
I just want to understand, going on with the do's list that you have, you've spoken about switching to SWP as compared to dividend scheme for meeting your liquidity requirements. How is this a tax efficient way of investing? If you could just decode this angle.
See, a systematic withdrawal plan is an opposite of a home loan EMI, if I have to draw up an analogy. When you cut a home loan EMI gets debited, there's a principal component and there's an interest component. Similarly, when you ask for money in the form of systematic withdrawal plan, let's assume I have a 1 crore invested. I can wait for dividend, or I can tell the asset management company to give me 50,000 rupees per month from my debt fund. When they credit 50,000 rupees, this 50,000 will come as one chunk, okay, which is nothing but 12 installments of 50,000 works out to be 6 lakhs per annum, right? So it's 6% per annum. Most debt funds give you that return. But when you take that 50,000 in your bank account, those units are of two kinds. One are principal units, the other are the full units. The full 50,000 is not your profit because there's a capital value and there is a return value. So if I try and summarize it so far, when you get a 50,000 credit, you don't have to pay tax on the full 50,000. You have to compute the return in that 50,000 rupees. It might just be 5,000 rupees out of your 50,000 rupees. So the tax implication currently will only be on the 5,000 rupees rather than the full 50,000 rupees. If this was 50,000 rupee interest credit from a fixed deposit, the entire 50,000 was taxable at marginal tax rate. In this case, it won't be that way.
Okay. Feroz, moving on, why do you think a growth option as per the options available under a mutual fund scheme is more tax efficient?
See, dividends now are added to your income of that specific year, right? If you are in the tax bracket of 30%, and if you have chosen an equity fund to be in the dividend option, if you got a dividend credit, like this happened with me, unfortunately, ironically, that there's one of the Franklin folios which stayed in dividend and they gave me a large dividend, and that added to my income straight away. And I paid whatever 42% last year as per my tax slab, including cess and surcharge. Otherwise, I would have paid only 10% tax if I redeemed it whenever I so redeemed it. So dividends in the country currently are taxed at the income slab you currently are. Let's assume you have no income, then there's no problem. But if you're already breached 10, 15 lakhs of income, every rupee you earn is going to be taxed at 30% incrementally. Whereas long-term capital gains is at 10%, short-term capital gains at 15%. So what's the point of having a sword on your head of 30% taxation?
All right. In the end, why do you think debt mutual funds are still tax efficient as compared to a fixed deposit, even after the tax change on them?
See, there are two reasons. One is fixed deposits. The tax of a fixed deposit is on a real-time basis. By which I mean, if you earned a tax interest in a fixed deposit this year, you will have to, irrespective of whether it's credited to your bank account or not, you will have to pay tax as per the accrual of the interest in the fixed deposit. But in a debt fund, if I don't sell anything for 10 years, I don't pay any tax for the 10-year period. So this tax deferral, so tax is collected at point of sale. If I don't sell, I don't have a tax implication. So this differential, because of power of compounding, diverges to be attractive enough. If both the instruments were to give the same return, I would still choose on a tax basis, tax efficient basis, I would choose a debt fund.
All right, let's quickly move on to the don'ts aspect also. And yeah, you can just take it one by one, Feroz.
Yes. So if you look at don'ts from a perspective of taxation, don't try and ever use some provisions which may look very optically attractive, but may not be active. So what you have to first do is try and check which is the better tax regime for you. The new one could just be a good tax regime. Don't just take the older regime because it has several provisions. Okay, ensure that you're not booking short-term capital gains unnecessarily. That's the second don't. Because when you book, now I see several people being agnostic. In February, they've booked a short-term capital gain because the short-term capital gains have a taxation of 15% odd. That's second don't. Third is don't eliminate Section 80D from your deductions because 80C is so popular. Section 80D gets ignored quite a few times. Don't ignore any of these sections of 80s, which can be attractive if you've chosen the older regime. Don't delay your tax planning because if you want to do prudent investing along with tax planning, it will require the might of time. So you can't do that last minute and still go right with your investments. So these are the few don'ts, Kavita, which come to my mind, which need to be internalized by most taxpayers.
Sure. So these were the tips on your tax efficient investing, but then on ITR Pathshala, we have something more for you. We are definitely in the middle of July. The deadline for filing your tax return is fast approaching. And in our brand new segment, ITR Pathshala, my colleague Bhavya Dua will simplify income tax return filing for you. In today's episode, she explains how to file ITR when you have income from other sources. So let's listen in.
There are so many heads in the ITR form while filing the tax returns. There is income from salary, from business and profession, from house property, from capital gains also. Oof यार, अब ये income from other sources क्या होता है? Hey, are you also confused about the same? Well, this says that any income that cannot be reported under any of the other heads has to be declared under income from other sources and has to be paid tax on. But what all actually comes under income from other sources? Come, let's take a look. The first one is interest income. Now, most of us hold bank accounts where the banks provide interest on the account balance. Additionally, many individuals invest in fixed deposits with either banks and or post offices as well as in other financial instruments to earn interest. Now, it is important to disclose this interest income as income from other sources when filing your taxes. However, taxability of interest income depends on the nature of the income. For instance, savings bank interest income is only taxable over and above rupees 10,000, while interest on PPF is tax exempt completely. The next one is dividend income. Now, apart from the interest, the other type of income that many people have is dividend earned from investment in shares and mutual funds. The taxability of dividends depends on the nature of the dividend. Now, dividends received from shares and mutual funds are subject to tax as per the marginal slab rates applicable to the individual taxpayer. But the taxability of the dividends in the hands of REITs unit holders depends on the taxation system opted for by the special purpose vehicle. The next one to pay attention to is gifts received in cash or kind. You may not think that gifts are taxable, but according to regulations, gifts received by an individual in a financial year are exempt from tax only if their total value does not exceed rupees 50,000. So if the value of your gift exceeds rupees 50,000, it is taxable under the head income from other sources, unless it is received in marriage from a relative who is your spouse, brother, sister, or spouse's brother and sister, or the parents of the recipient, or under any will or inheritance. The last one to look at is income from lottery or prize money. Income derived in the form of winnings from lotteries, competitions, races including horse races, card games, gambling or betting of any kind is categorized as income from other sources. They are subject to a flat tax rate of 30% without any exemption. Therefore, the payer of the prize money typically deducts tax at source from the winnings and disperses the rest to the recipient. So make sure that you do not miss out on filling in this section while filing your returns. And hurry up, because 31st July isn't too far now.
All right, so these are the nitty-gritties as far as income from other sources are concerned and as filing in the ITR is concerned. So this is all on the ITR Pathshala, but just in case you have any question that's related to your ITR filing, you need last-minute help, do send us your query to the Money Show on our WhatsApp number as well as our email ID. But then quickly, let's move on to our other topic of the day, which is the RIL demerger and the cost of acquisition and the tax implication when you go to sell any of these shares. So, Feroz, coming back to you, could you please explain the cost of acquisition that's been given by the company?
Yes, Kavita, see, it's reasonably simple. And this is not just for this demerger. In a life of investing of 10, 20, 30 years, you're going to have several similar instances. So understanding this could be very useful. See, the logic is very simple, that in the case of Jio Financials, the acquisition cost is going to be considered as 117 rupees. Let's take an example of you buying 1,000 shares on 1st of April 2021. On 1st of April, if you've bought 1,000 shares of RIL at 2,500 rupees, that's the amount you paid. You bought 1,000 shares, which is an investment of 25 lakh rupees in rupee terms. So you invested 25 lakhs and bought it at 2,500 rupees. Now, that has been demerged and 117 rupees is the value of Jio Financials. So if 117 gets out of 2,500, then you're left with 2,383 rupees. So your purchase price of RIL is 2,383 and your purchase price for Jio Financial Services is 117 rupees. So now you got the split. Now, this demerger does not attract any tax by itself unless you intervene and sell either of these. So when you sell either of these, the capital gain will be computed from the new purchase price, which is a split of 2383 and 117 respectively for these two businesses. If you sold it at 3000 RIL, your tax implication would be on 3000 minus 2383 rupees. And that will be the date of purchase will be considered not from the demerger date, from the date of your actual purchase.
Okay. All right. I think that will be all. Thank you so much for decoding this maths behind the demerger. Thank you so much, Feroz, also for being on the show and helping our viewers with every aspect of financial planning today. And on that note, it's a goodbye from me as well on the Money Show. But then I'm going to leave you with our WhatsApp number and email ID, where especially on your ITR filing, if you have any doubts, you need any last-minute help from our experts, do send us your question along with your mutual fund portfolio queries questions. Thank you so much for watching. Goodbye.